surprised by the lack of repercussions showing up in US economy. One would have thought that the tariffs will have its own cost in terms of price of those imported goods, in turn reflecting in inflation, or if the companies choose not to pass it on to consumers, that should get reflected in their profit margins and hence earnings data. Yet neither growth nor inflation nor earnings seem to be showing any effect on that.
If you look at the markets, at the market level, on absolute basis, of course, we're kind of higher than where we are actually before all these things started, right? And the broader expectation in long-term inflation in the US is around 3 to 2.5%. So US imports somewhere between 10 to 12% of their goods as a percent of GDP. And the effective tariff rate, given what we're hearing, somewhere is going to be between 13 to 15%. Prices going up will be shared among primarily three groups. Almost 60-65% of this impact has been borne by the US companies. Around 20-25% has been borne by the US consumer, and the balance has been borne by the foreign companies who are actually manufacturing them. Right? Now, going forward, we don't know what is going to happen. But broadly, if you think about in a simplistic way, 1/3 of things will be borne by consumer, 1/3 by the foreign manufacturers, and 1/3 by the US distributors. So basically, you are talking about a CPI jack up or going up by around 50 to 60 basis points.
The AI economy in the US is squeezing the rest of the economy. Almost 40% of incremental GDP growth is now attributable to AI. $400 billion of capex run rate on AI infrastructure. We assume that these companies are making so much money they'll be able to fund it. But the latest news that they're actually borrowing to spend it came as a surprise.
You need companies which are riding this wave. It doesn't need to be real NVIDIA, can be something else. For example, we like TSMC quite a bit. We don't know who is going to win the race in longer term. If it is NVIDIA or something else, from AMD or maybe something else, we don't know. Our consumption basket is trying to cater to these longer term trends, which are probably not going to end soon. Our overarching goal is that to find companies which can give you low to mid-teens CAGR in their fundamental compounding.
Hello and welcome to another episode of Marcellus Musings. Today's guest is somebody who's appearing for the third time, Arindam, given he manages a global portfolio which has disproportionate exposure to the US, and there's been a flurry of action in the US. I guess that explains the third appearance in 6 months. And each time we catch up, there's plenty happened already. So there's a lot more to discuss now. So thank you, Arindam, for joining our episode today.
Thank you, Pramod. As you said, I just recollected actually this is third time, and I definitely do not want to be that frequent. But that's how it has been actually last 6-7 months. A lot of things going on. Happy to be here. Hopefully, we can add some value, or at least share our thought process. How we are thinking about certain things.
Well, unless you have any influence on the US presidential office, I guess my sense is you'll keep coming to this quite frequently. So lots happened since the last time we spoke, especially the tariff saga doesn't seem to end. Back home in India, we've been given a shock, given you had the 25% tariff, which was unexpected. On top of that, potential 24% more. But having said that, a lot of people have been surprised by the lack of repercussions showing up in the US economy. One would have thought that the tariffs will have its own cost in terms of price of those imported goods, in turn reflecting in inflation, or if the companies choose not to pass it on to consumers, that should get reflected in their profit margins and hence earnings data. Either way, growth should get a drag. If the consumers are taking a hit, obviously they'll have to stop spending elsewhere to fund that. If corporates are taking a hit, they will obviously take a hit in terms of their ability to spend on growth. Yet neither growth nor inflation nor earnings seem to be showing any effect on that. What's your take on that? What's transpired?
Yeah, that's a very interesting observation actually, Pramod. So if you look at the markets, at the market level, on absolute basis, of course, we're kind of higher than where we are actually before all these things started, right? At the index level. Even below the index, if I look at all the 500 stocks, just take an equal weighted basket for all the S&P 500 stocks, it's still again it is also back in the same level what it was before going into the tariff. So um, of course, the first major kind of reaction that we saw was the fear of unknown, that I do not know what is going to happen. And typically, as you know, markets don't like uncertainty. Any kind of certainty, gives some hope, and you quickly rebase your estimates. So if you just think about what happened in last, say, 6 7 months, let's break it down in two ways. One is on the inflation side, and secondly on the market, the earnings per share estimates, what we have seen. So on the inflation side, I think, as I said, like at the beginning of February, we didn't know what is going to show up in terms of effective tariff rate, or ETR, which is often referred to. So on the inflation side, if you think about what people are expecting, the broader expectation in long-term inflation in the US is around 2.3 to 2.5%, somewhere between that. And the way we can gauge that is looking at the tips, right? The inflation-linked bond, what the rates are. It's a kind of break-even inflation rate, 10-year break-even inflation rate. So that is what gives you what market is expecting in the long term. Switch is again around 2.3 to 2.5%. That's what it is. Now, if you just put some numbers around the import data, so US imports somewhere between 10 to 12% of their goods as a percent of GDP, and the effective tariff rate, given what we're hearing, is summer is going to be between 13 to 15%. I'm not talking about India here. I'm just completely focusing on US, what their consumers were going to face. So think about it, that 10 to 12% of import goods, that will get a 15%, 13 to 15% tariff, right? So if you just put the number, so it is basically multiply 10% into 15%. So it is around 150 basis point of hit at a broad level in terms of prices going up. Now, this prices going up will be shared among primarily three groups. Number one, the consumer, right? The end consumer, the US consumer. Secondly, the guys who are actually distributing them or bringing them in the US. The third group is the manufacturer, the foreign manufacturers who are actually sending them back to US for selling, right? Now, so far, what we have observed, we have seen some data from, I think Goldman Sachs came up with some data analysis here, that almost 60-65% of this impact has been borne by the US companies. Around 20-25% has been borne by the US consumer, and the balance has been borne by the foreign companies who are actually manufacturing them. Right. Now, going forward, we don't know what is going to happen. But broadly, if you think about in a simplistic way that, one third of this entire 150 basis point of things will be borne by consumer, one third by the foreign manufacturers, and one third by the US distributors. So basically, you are talking about a CPI jack up or going up by around 50 to 60 basis point, right? So now add that 60 basis point to the long-term break-even inflation rate, that takes you to around 3.1% inflation rate end of the year. And if I look at the economist, what they're projecting, that is where the numbers are actually hovering around. So the point being, market tried to, or the people actually, the market participants, they tried to put that in numbers. So again, the uncertainty part was removed. Yes, it went up, but the uncertainty part was removed, right? So that was one thing.
If US imported goods and services, you said, was barely 10% of GDP,
right?
What's the big deal that Trump is making that America is being subjected to all these imports? Is this a net import number where American exports of services sort of offsets this? If you take goods only and gross imports of goods, is this still such an insignificant number? In which case, what's the big deal about Trump saying that we are giving away all our consumption to foreign companies?
You are right. It is not a big absolute number to some extent. In my view, what the way I see it is he actually, not him, but broadly the entire group, which is kind of talking about the tariffs. They mentioned that they want to use their partner countries, right? Their funds or their wealth as a sovereign wealth fund, and make them invest in the US, right? So they don't want to spend their own money given their fiscal situation, but they want to make sure that they're getting funded by in different form, right, by the other countries. So again, if you look at like all the big fuss around what they're talking about, yeah, I mean this number doesn't look
Wasn't
that
that already happening? I mean, pretty much every exporter to the US was sending capital by buying US treasuries. Pretty much every asset allocator outside the US was loading up on US tech companies. So whether it's US bonds or US equities, there was already a massive capital account surplus there.
right?
Coming back to the point about just clarifying, you 70% of US GDP is consumption, right?
Consumption, yes.
How much of this is goods and how much of this is services?
I'm assuming around it will be around 50-50, close to half of that, but I have to see the numbers there,
And
right?
if 35% of the GDP is goods consumption, how
Yeah.
much of that is imported versus locally made?
I think broadly it is important. There's very few locally made,
Correct. So
right?
that's why I was surprised at the 10% number. I would have thought it's
It
closer to
was
the
net.
30% number.
Yeah, it's kind of net. Yeah.
Okay. Okay. Fair enough. So you're saying adjusted for existing tariffs from
Yeah.
a host of country hasn't gone up really, but
Yeah.
presumably countries like China, Vietnam, Korea, Taiwan are large, and
Right.
there has been an increase in tariffs there that should
Right.
get reflected in the cost of imports.
Right.
So you rightly mentioned the three entities involved as the consumer, the importer, and the exporter.
Right.
Right now, bulk of the hit is being taken by the importer and
Right.
exporter, leaving the consumers largely unscathed.
Right.
This could change, right? This could change. At the end of the day, America is a capitalist country. At some stage, the importers will pass it on. And
Yeah.
worse, the exporters might find other markets which
Yeah.
are more attractive.
That's true. I think the first thing, right? The consumer might get hit quite hard. That is the worry that I think most of us have going into next year. The worry is fair. I mean, to be very honest, I mean, if you look at the situation of consumer in the US, they're healthy, but they're not in a situation to splurge money, right? In different categories. That's what I have seen. There are very few categories who are actually doing pretty well. But broadly, if you look at the consumer market, I mean, if you can just take out the online part of it, and you take out the some luxury spending, etc. Broadly, the market hasn't actually done anything, right? So
In
our
fact, the
base
reported data for the first half of this year, considering December 2024 as the base, says that inflation adjusted consumption expenditure growth is zero.
Actually, yes, inflation. Yeah, that is absolutely true. So it's a very selective way of spending. So people are kind of spending on lifestyle or experiences, but they're not really spending on certain other things that they used to do, right? So again, so very targeted kind of spending that has happened, and that is because of this worry that inflation is going up. If you think about last 2-3 years, house prices are going to the roof. Yeah, and so that is what made people worry, which is actually good to some extent. So they are not, unlike the 2004-5 that time frame, they are now much more, conservative in terms of their spending habits, especially in the middle and upper middle class, that segment of the society, right? So again, as you said, that the mix might change, and I think the consumers are kind of positioning for that. So what it is doing in turn is it is actually creating a very solid base, in my view, that you are kind of making a part of your savings or in different forms, right? You're not taking additional risk that might burden you going forward. But at the same time, if we get into a situation where the inflation is controlled by say next year, say around 2.5%, what the market is expecting, and there is not too much of job losses. The job creation keeps on going at a pace, what we're saying now, and the tariff uncertainty is removed, right? So the conglomerates or the companies that are actually pausing some bit of hiring, right? So they come back to the normal pace. Then you can might see a bit of rebound in real consumer spending. As you said, the consumers real consumer spending hasn't been there actually, so that might come up, right? So that is actually our base case. On the other side, what I've been seeing in last 12 months or 18 months, as you know, right, I've been seeing a very kind of different kind of market, right? On one side, there's AI economy, which is kind of holding up bulk of the market. And on the other extreme right side, we're seeing the banks are actually doing extremely well because, as I said, like the consumers actually spending very judiciously. The corporates are not over levered, so there is no NPA. At the same time, the inflation continues to be on the higher side, right? So you're kind of passing on higher interest rates. So your NIMs are kind of holding up. So again, for a portfolio like GCP, that has been a kind of classic positioning that we are not too focused on this top heavy names. On the other side, we tried to avoid this highly regulated entity who are very much rate sensitive. So that has been a little bit of challenge on a relative basis, right? So I mean, we are doing as probably a little better than the market. But if our base case plays out, probably the portfolio is relatively better positioned in that scenario that the consumer spending suddenly goes up. The economy becomes much more broad based rather than just everything going into a AI kind of that kind of spending. To be very fair, I'll just tie it back to what you asked your earlier question that what we are seeing in terms of earnings, etc. So since the trade over thing started, the earnings broadly in the S&P 500, that's a downgrade of around 2.5 to 3% for next year. That have started to bottom out. So the revisions are actually coming up. If I look at the last quarter, like the reporting that happened, uh, the broader impact was in the smaller and mid cap, right? The broader in those mid cap index actually saw a revision of around downward revision of around 7%, right? And we are seeing that is also finding some base. Okay, now that 6-7% number is actually expected. If your broad-based index is going down by 2.5, you are supposed to see higher impact because the borrowing cost remains higher compared to what people are expecting. At the same time, the spending might get deferred because of the uncertainty, right? So again, as I said, like now what it looks like if I look at next year, after a long period of time, the expectation that the mid cap index will grow higher than Nasdaq. Okay, so Nasdaq is expected to give you around 12-13% EPS growth. The mid cap is expected to give you around 17%. Now, which is very rare, as I said, because the mix is, that heavy, that is not take heavy that much. So the mix is not supportive to them, but it is kind of a classic cyclical rebound that might play, for next 12 to 18 months or 12 to 24 months. We don't know, but we'll see how it happens. But so far, that's what we are seeing.
I'll just quickly touch upon this report that SocGen put out just recently, I think late last month, about the divergence in earnings growth for the top 10 companies in the US and the remaining 490 of the S&P 500. It
Yeah.
was quite stark. They indexed it to, I think, June 2021 and ended it with June 2025. It's on a 4-year basis. The top 10 indexed at 100 in June 21 now is almost touching 200. It's doubling in 4 years.
Right.
Whereas the remaining 490 goes from 100 to barely 120 in 4 years, which is something like 4% CAGR. Now, I know 490 is a huge number. There are various pockets within that. How do you read this? Because we've been saying that, yes, big tech or the big companies have been given too much attention, whereas the small and mid cap is still very attractively valued, but the earnings growth has been very strong. How do we reconcile this earnings growth being strong and this data from SocGen?
Look, I mean, there is no doubt, whatever the rally that you have seen in the big tech or these top 10 companies, they're actually backed by really strong fundamentals. So there is no doubt about that. Barring select stocks, like you can talk about, a Tesla or some Palantir. I mean, those are their pockets where you can actually say that, this just seems too far, doesn't make sense. But that is always the case, right? With any market, you'll find pockets of this weird, misplaced kind of optimism. But broadly, you're right. I mean, I really do not think that there is much of, in terms of, I would say, I don't deny with what the market is saying that they have delivered earnings. So market has duly rewarded them, right? Um, what we think is that when you are looking at investing, you are looking for the inflection points, right? That okay, this thing hasn't worked for last 3 4 years. Is there a decent chance that this might start to work, or it is like it is structurally broken, right? So that is the question we need to ask. From that standpoint, I think as of now we don't see too many things structurally broken. As I said, as you said, the real consumer spending is close to zero. Now, if you think that uh, we're not going to see massive job losses, that holds up okay, then it is a matter of, and the real wage growth is positive, then it is probably a matter of time that it tracks the real wage growth. If your real wage growth is around 1.3, 1.5%, then it eventually should track there. So that delta from 0% to 1.3 to 1.5%, that is where probably there is some money that can be made, right?
Right.
And again, we don't know what is going to happen, but that is our base case. And secondly, the other thing, if whatever Trump is doing in terms of getting some of the things back in the US or whatever it is, if I look at last 10, 15 years, so looking at from say 2012 to now, if I look at the industrial production data in the US, it is barely, I think, 1.5%, right? Again, not expecting much, not expecting much. We are just looking for, okay, what if in last 4 or 5 years, the industrial production data has barely moved? Should we get a cyclical uptake? If we get that, then you get into a situation where your big tech, which has delivered like fantastic 18% CAGR or 19% kind of earnings CAGR, so probably they gets to say 14, 15, which is still pretty healthy. But what if these guys who have not done anything for last 4 years, suddenly you get to a 14, 15% CAGR for next 2 3 years? I'm not pinning out, they're not structurally that good as a Microsoft, for example. But what if you get to that? And the valuation disconnect is pretty big now. These are trading at 30 times. These guys are trading at 15, 16. So there is a chance of convergence, right? That might happen. So just a corollary, if you think about what happened in India between mid of 2017, when the mid cap thing that popped, right, in India, till mid of 2020, this entire cohort seemed dead. The entire capex, etc., seemed dead, right? Uh, Now, what happened after that? That can give you some glimpse, and it has happened in many other markets over time and again. So that might be the case, right? So again, we don't know, but this is what we're seeing, or this is what we
No, that'll
expect.
be great. From a Marcellus standpoint, we missed out on that inflection point in India. If we can capitalize on the inflection point in the US, we'll at least absolve ourselves of some guilt as an institution. Hopefully, you get this right. Um, yeah, but very briefly, you talked about if job losses don't happen, job creation stays steady. Given what Trump has done, sacking the person reporting that jobs, where do you track the jobs data?
Um, Look, I mean, the ADP data is probably the most relevant, and that's how I look at it. So the jobs data is like, I mean, look, it is expected given what is going on in the tariff, etc. There is bound to happen some choppiness. Now, how do you clean that out is very hard to do. What we do is like we get anecdotal evidences, so, what is going on, etc. The tax collected, those are real data, right? Those things are fine. I think the tax collected, kind of a GST equivalent in the US that went up by 3 4%, right? So again, those things, if you look at previous downturns, they tend to turn negative before the real challenge starts to happen. So again, the tax collected data is something that I follow pretty closely, and that weekly or bi-weekly numbers that comes to that seems to be pretty okay as of now. But again, the hiring has tapered off because of what is going on with the tariff. People want to see what really happens. And on the other side, as you know, the AI related, the efficiency driven job cuts that are also taking place. But I'd kind of remind one thing that, the tech workforce that has been laid off, uh, the numbers are uh, high, but they're not significant to, the break down the entire kind of economy or etc. what people talk about, right? So again, we'll see. It's kind of very fluidic situation, but as of now, we have not seen any big red flags in terms of what's happening in the US job market.
Yeah, that brings us to the AI related job losses and the AI related impact on the rest of the economy. The Economist put out a piece earlier this week talking about how the AI economy in the US is squeezing the rest of the economy. One
Yeah,
way, they showed is almost 40% of incremental GDP growth is now attributable to AI, whether in the form of the hyperscalers spending on GPU infrastructure or the energy needs that is creating, so on and so forth. 40% of GDP growth explained by AI, when the AI's base is pretty small as a percentage of overall GDP. That's a lot to say. You already alluded to AI impact in terms of job creation. I recognize the job cuts so far are not meaningful, but in the context of incremental data where job creation was the need of the hour, clearly the Amazon CEO, the Microsoft CEO, all have gone on record in terms of talking about their own relatively lesser need to have people
yeah,
in their organizations. And thirdly, impact on energy, right? And through that, inflation. These are energy guzzling data centers that Microsoft, Amazon, Google, and Meta are putting up. And the amount that they're spending is no longer trivial, right? It's almost running up to $400 billion per annum run rate. Who knows, in 3 months' time, that could have gone up as well. That's creating bottlenecks in energy prices.
right.
I think it was Eric Schmidt who talked about the limitation for AI as of now being electricity. That means that they'll guzzle up all the electricity available, which will have its own impact in terms of inflation, the energy available for other sectors, and so on. And lastly, and this came as a surprise to me because when we saw the numbers, like $400 billion of capex run rate on AI infrastructure, we assume that these companies are making so much money they'll be able to fund it. But the latest news that they're actually borrowing to spend it came as a surprise, which in turn can have implications on rates, right? Which means that the rest of the economy will have to live with higher borrowing costs, whether it's the consumer or this one. And there doesn't seem to be any end in sight.
Yeah.
These companies are spending like there's no tomorrow. Um, so, given this two-speed economy, like you said, on the one hand, AI is driving everything, and it has implications for consumption, inflation rates, and so on. How do you position your portfolio in this sort of a situation?
Yeah, no, I mean, look, we took a barbell approach. You need companies which are riding this wave in different shape and form. It doesn't need to be real Nvidia. It can be something else. Like for example, we like TSMC quite a bit because, as you earlier said, right, we don't know who is going to win the race in longer term. If it is Nvidia or something else, from AMD or maybe something else, we don't know. But the ASICs, right, that is picking up. That every company want to make their own, but you have to go to NVIDIA. So there's a de facto. So there's a simpler way to play that. So one thing, so that is one, like you have a pot of companies which are doing that kind of stuff. And the second leg, like we're trying to play the second, the inflection point that if the economy, picks up, right? What we are seeing, for example, all these things, what you're saying about AI, etc., it actually doesn't really solve the bigger problems of the world. If you think about the inequality or like richer getting richer, I mean that's how it is actually heading to. In fact, the bigger companies are actually utilizing AI in their workflow much better than a smaller company, right? So that creates differentiation. So again, so our consumption basket is kind of trying to cater to those polarized society, like which is getting richer, right? So again, we have tried to position it that way that you're trying to cater to these longer term trends, which are probably not going to end soon, right? So as I said, again, but some of these companies are like, for example, LVMH is a classic example. They're seeing this slowdown. So for last 3 years or 4 years, their sales have stagnated because they saw a rapid pickup during the COVID spending, right? So again, we believe that if these longer term trends are going to continue, there will be a cyclical rebound at some point of time. We don't know when, right? So again, it's been a mix of both the sides that we're trying to catering to. Our overarching goal is that to find companies which can give you low to mid teens kind of CAGR in their fundamental compounding. And that is one of the reasons that we've actually missed out to some of these banks, for example, that, I cannot really predict rates, but it's very hard for a bank to compound at that level. They're just, unless the valuation is very palatable. So again, so we are not taking those bets, but we are trying to balance that. Okay, if the economy picks up, at the same time, the companies that are actually seeing some of the benefits of what is going on. One interesting thing that I think people do not talk about that often, all these big takes are supposed to be, capitalism without capital. That entire cohort, that entire thing was built on that narrative, right? Now it simply looks like, some things never change, right? So there's,
Absolutely.
yeah,
It
some
was
things,
supposed to be intangible assets. Michael Mauboussin did a lot of work to assess this. The whole thing has
right,
been turned upside down. Upside down. The biggest companies are spending more than I read somewhere. Other than the big railroad capex boom,
right,
this has now crossed every other capex boom, whether it's the IBM data centers or the telecom boom of the dot-com bubble.
right.
We're well past that already in terms of capital intensity.
Yeah, and that is adjusted for GDP actually.
Correct.
Yeah, so that is some things. I mean, investing. I mean, like you talk about this time is different, but when you really think about and take a long view, you understand. Okay, some things are actually, it comes back, and you don't know when. The cycles can be really long, but yeah, the basics don't change.
So on that point, I see you own all four hyperscalers in your portfolio. You've got Microsoft, you've got Amazon, you've got Alphabet, and you've got Meta.
Yeah.
Um, aren't you worried how they're going to make money out of this $400 billion investment? Where are the use cases? What if those use cases don't pan out? Is this all money gone down the drain?
Yeah, I mean, look, I'll be very honest with you. There is a clear admission that we like Microsoft, we like Meta, we like Amazon, in that order. But the reason we hold something like an Google, for example, because they're so big, we have to do a bit of risk management. So you really cannot escape that, and the stock trades at around 20-21 time PE, right? So you never know. I mean, the risk that you talk about, perplexity or other things coming in and kind of kill them, but they're very decent cash flow, right? So that they have the ability to counter those things. So the reason we like Microsoft is because of the discipline around. They're probably the most disciplined in among all these companies that we're talking about in terms of managing their cash flow or capital capex spending or whatever you can call it. They're most disciplined. So if something goes wrong, suppose the ROICs of the return on capital that they're investing on their customers are actually doing, that doesn't play through. I think Microsoft will be the most. They'll be behaving the most rational way, right? So that is
Right.
one thing. In Meta, what we like is about the man. It's a founder-led company, and it shows up in many different ways, right? You can take a bet that Meta can actually reinvent themselves time and again. That is the simple way to put at it. I mean, you can talk about Instagram or whatever they do in the ad side, but that is the fact. He can take tough decisions. So he's probably the only CEO I have seen in large cap in last 10 years who have actually come to a conference call and say that, what, in 2017 or 2018, he came out and said that, we are making a 45% or 40% operating margin, but next year we'll be making an operating profit of around 30%. The stock dropped by around 25-30%, but he was okay to take that. That is not something an MBA graduate can do. So they are typically that slow bleed. I just want to make sure manage things like that. So that is very unique about Meta, right? So the downside of that is you find a year like 2021 that they become so aggressive around spending through that whatever the TR, VR, etc. That burnt a lot of cash. But the upside, which I think much outweighs, especially given you're in a kind of disruptive sector, much more than a downside that you survive. multiple cycle, right? So that's about it. Amazon, we are actually a little bit, I would say, more balanced in our view. What we didn't like about Amazon is they're actually losing market share compared to the Google Cloud or Microsoft Azure. Azure is actually doing fantastic job, right? So we're a little concerned there that what is going on. Is it the big company kind of dynamics kind of catching up with Amazon as well? But otherwise, I mean, Microsoft and Meta, I think they are kind of they're well positioned in terms of we are not happy with the kind of capex spending they're doing. Especially Meta is the company that you're actually giving example of, right? Actually, they might need to borrow, especially if they try to continue the kind of capex spending they are doing. But at the same time, they have the capability to course correct. If they find that things are not going in their favor, they can take that drastic decision that okay, I'll just cut it down, I'll stop it there, right? Not many companies can do that, right? And remember, for any company, they will have their ups and downs. The ability to recognize that you were wrong and you should course correct is important. That's what I think both Meta and Microsoft are better positioned.
Right.
So to summarize your point, I mean, yeah, we are definitely looking at the capex spending, but at the same time, we think that these few companies can survive that something goes wrong.
Fair enough. I just want to touch upon some pockets that could be obvious gaps in the portfolio. We talked about the limitations of AI being electricity. What are we doing to capture that? Effectively, energy providers are also neutral arms dealer, right? It's the
Yeah,
most neutral in terms of arms dealing. It doesn't matter whether Microsoft, Google, um, Amazon wins the hyperscaler race. All of them will have to consume that energy.
yeah,
Uh, what are your thoughts on getting exposure to energy?
yeah. So energy, there are two things actually. I mean, two subsectors that we like quite a bit, and we are kind of we are answerable to only ourselves because no one stopped us to own any of those. But oh, we never owned in my career. I have barely owned any IPP or independent power producers, right, in the US. So they are supposed to be very cyclical. So that bias actually played in my mind till early this year.
And the last piece is China. I know yours is a developed market strategy, but there are implications from what's happening in China. First, the bargaining part they've exercised with the US, with the card that they played on rare earth minerals. The US has already been very lenient. They've not only have they extended the tariff holiday, they've also given in to shipping NVIDIA chips to China. In some ways, clearly China's heft is as visible. I mean, no other countries managed to exercise that sort of bargaining power with Trump. And also the most recent development in terms of anti-involution that's happening in China, right? So one of the reasons for not investing in China was China created such a competitive economy that most companies did not make money. Um, if that is changing at the margin, suddenly some of the good companies in China become more attractive. What does that mean for capital flows? Clearly, asset allocators will be looking at China and EM indices more favorably. How do you factor that into your developed market strategy?
So what good thing about looking at US or Europe is that these are like very deep markets. So even if you're not directly investing in China, you can still play some of those dynamics. So what you're saying, if China becomes more rational, broadly our companies will have at least 10 to 15% of their business out of China, right? So what they have done historically is that they have tried to identify the niche where the volume game is not played, right? So the volume is typically played by the Chinese companies, and they have tried to find niches around, be it something just simple as research lab weighing machines, right? So they have been playing that way. But the reason that they have not tried to expand that because they are aware of that this can be a challenge if I go into certain other segments, right? So again, in US it is you cannot definitely play a power kind of pure play Chinese this kind of things, but we have different ways to at least participate to some extent. What is happening in China. It will be actually very good for industrial economy The entire industrial economy, if you look at it, the reason US kind of gave up because they're just not cost competitive. If you think about the kind of volume that they're producing, right? So it can be really, really good for broad industrial economy across the world, not just US, Europe, both. So we'll see how it plays out. I mean, that also comes back to Trump asking people to move factories in the US. So that argument probably becomes a little more palatable, right? When I have a rational competitor. But having said that, probably at some point of time, I mean, if we get that capability kind of built in ourselves, that we can analyze some reasonably good companies which has maybe listed in Hong Kong or somewhere, and explore those. If you understand the businesses, if they're clear enough, in terms of communication, why not? I mean, at some point of time, but right now you do not have the capabilities, so we're kind of playing it in the secondary way. Industrial is the best way to play any China good story out of China. Industrial is the best possible way to play that, and we are over at industrials, and probably that is a sector we're comfortable in terms of playing this kind of thing. So we'll see how it plays out.
I know you started your career as an industrials analyst and it's your favorite sector as well. But I also want to share with our listeners that industrials as a sector in the US has perhaps the most pristine track record in terms of long-term shareholder returns, even more than tech by some measure, which came as a surprise to me. But thank you, Arindam. Very interesting. It's always a pleasure discussing with you because you never talk your book. You give us all possible scenarios, including scenarios where your book may not work. But that suggests that you keep an open mind and you're open to those risks. As long as you're open to those risks, we're confident you're going to take action to mitigate those risks. But pleasure talking to you and thanks for coming on the show.
Thank you, Pramod. Yeah.